I just have a quick question. Does IFRS have rules around disclosing significant influence for public companies? Like say someone has a 20%
Oh, yeah.
ownership?
So basically, because for this investment, right, this is your financial assets, right, your investment, you have to disclose how you accounted for, right? What's the measurement base? The measurement base would be, equity method, right? You are going to learn it in the advanced financial accounting. So, and then you have to disclose what is the type of the category. This is associate, right? And what's the percentage of the ownership, right? And you're going to use equity method to figure out what's the value of that investment on your balance sheet. So yeah, you need to disclose this. And you are going to learn this in the advanced financial accounting. Yeah.
Okay, thanks.
Yeah. Anyone else? Any other questions? Okay. Okay, we should move on. Do you guys have a midterm coming? Does anyone have a midterm coming soon?
I have one this weekend.
Oh, this weekend.
Also, I have.
Okay, which course is that?
Business law.
Okay, so I'm just wondering because we only have 28 students today. Normally we have close to 40, right? So I'm just wondering what happened. Yeah. Okay. Now let's take a look at this question. Okay. Now let's put you into a test. The first one. Okay. You tell me which category. Okay. Subsidiary, joint control, or what's the other one? Associates, right? So investment in 800,000 shares of the company. This company is a public company with 2 million shares outstanding. What is this?
Investment in associates.
Okay, thank you. Associates. So
Yes.
800, right? That's how much shares you own. And then the total common shares outstanding is 2 million. So you are taking 40%, right? 40%. So that's associate. The next one, purchase of 800 shares of Dupree Donuts, a private company with 1,000 shares outstanding. What is this?
Subsidiaries.
Subsidiary.
Very good. Yeah, good. Thank you. Because it's 80%, right? 800 shares divided by 1,000, 80% shares. Sorry, 80% of the ownership. This two is tricky. Okay, I'm just warning you. The two left are tricky. Investment in 60% of the outstanding shares of Fruit Loops fountains. Agreement with the company's founder specifies that the founder retains the right to make all operating decisions for the company.
Joint control.
Joint control. If it's joint control, because this founder said, guess what? I have the right to make all the decisions. That means I don't have to listen to you, right?
Mm-hmm.
So if it's joint control, then everyone's opinion matters, right? So it's not joint control.
Full control?
Excuse me, women.
Would it be associated?
Associates? Very good.
Because you don't have control.
Yeah, very good. Okay, so it's associate.
So,
even though your ownership is more than 50%, but guess what? Okay, the founder will make all the decisions, operation decisions. So you still have no control, right? But you have influence, right? I'm pretty sure you can go talk to him. What you want to be done, right? You have influence. So this is associate. This is associate. 60%.
So
20%. Yeah. Go ahead.
Would the founder's shares be like preferred shares or voting shares?
So, it could be either, I think there are 40% of voting shares, but this is the agreement, right? This is the agreement between the company, the two parties, right? Maybe, the investor does not know too much about this business, right? So then you better not step in to give any decision, any opinions, right? the founder has the expertise that is fully respected. So therefore, they are willing to make this kind of arrangement. Okay.
So
But
he just waives his rights.
Pardon me?
He just waives the right kind of deal.
Yeah. So you know, the agreement specify that the founder retains the right to make all the decisions. Okay.
Thank
But
you.
you have influence, right? I'm pretty sure you, even though this is the agreement, you can just call him, you know, talk to him, right? Share with him about your concern, right? So you could exert significant influence, but you have no control, okay?
Yeah.
The next one, St. George Company buys 15% of the outstanding shares of gigantic gargoyles. After the purchase, St. George appoints its chief executive officer to the board of directors of the company.
That'd be associate too, because you still have significant influence.
Okay, good. Very good. So if you go by the percentage, 15% is under 20, right? So that means, you know, you're tempted to say nothing, right? You know, you don't have sufficient investment. But because, you know, this company have a representation on the board of directors, right? So that representatives can speak for the company, right? You know, so there's a significant influence. Okay, does this make sense?
Yep.
So this question shows us that generally you are going with the percentage of the ownership to make a judgment, and then you also want to be careful, right? On the essence, it's really about your decision-making power, right? On the essence, it's really about your degree of influence, okay? Any questions on this? Should I move on?
Yep.
Okay,
Yep.
Thank you, thanks. Okay, so so as I mentioned, we are going to focus on this chapter. We are going to focus on the non-strategic investment. Okay. So then there is the fair value. Okay, measurement, fair value through profit and loss. That's called FV, fair value, PL, profit loss. Okay, fair value through OCI. So FV, fair value, O means other, C means comprehensive income, okay? Profit and loss, that's on your income statement, right? And the other comprehensive income, remember, the income statement has two portions, right? You have an income statement and other efforts, right? Because of the concept of other comprehensive income. You also have a section to deal with other comprehensive income, okay? That's the difference. Whether you recognize through income or you recognize it through the other comprehensive income. And the last one is amortized cost. Okay, amortized cost. We're going to talk more about it. What do we mean by this? Okay, so for non-strategic investment, if it's equity, if it's shares, okay, generally you can only classify these equities into FVPL, okay? Unless you go through a special election, then you can classify it as OCI, okay? You can, through an exception, through a special election. Normally, you are going to classify the shares, the non-strategic investment, those shares, equities, as a fair value through profit or loss, FVPL. This is the category. I'm going to show you one example, okay? So suppose company ABC bought 100 BMO shares at a total cost of $1,000 in February, okay? At the year end, December 31st, the fair value of the 100 shares is now, $1,200. So there's an increase of $200 at the year end. What's your journal entry? What's your journal entry? Okay. So can anyone tell me what's my journal entry when I purchase the shares in February. What's the journal entry in February when I first purchased these shares? Okay, no one say anything. This is your
Debit FVPL investments.
okay.
Credit cash.
Credit cash. Okay. First of all, let's talk about this, right? Is this a strategic equity investment or non-strategic?
Non-strategic.
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 Yeah, because you only have 100 shares, right? what's the percentage of ownership of BMO, right? I don't think I can afford to invest like more than 50% of the ownership of BMO, right? So this is a non-strategic investment, right? It's definitely under 20%, right? So then, is this the equity? Shares?
Yes.
Yes. So then which category it goes? It goes, there's no election, right? It didn't tell us about the special election. So it goes to fair value PL, right? So that's very right. You are correct. So you debit FVPL investment. I have just explained why it's FVPL, right? On BMO shares, for the cost is $1,000. You credit cash for $1,000, right? Any question on this? Okay.
Sorry, could you?
Yeah.
Sorry, could you say like what you said about the strategic or non-strategic part in the question, because you said it's not possible for them to have power or influence.
Okay. Yeah, very good question. What's your estimate of 100 shares in terms of percentage of the ownership? Maybe like very
little.
You can ignore it probably, right?
Yeah.
Yeah. So then this is not a subsidiary, right? This is not a associate, right?
Okay.
Yeah, and this is definitely not a joint control. I don't think BMO will consult your opinions after you purchase the 100 shares, right?
Mm-hmm.
So this is definitely not a strategic investment, right?
Yeah, I was just making sure just because it wasn't like mentioned or anything.
Yeah. So then this is a non-strategic investment, and then it's equity, it's shares. So this generally is classified as FVPL. Okay. So you have to make clear this is a FVPL investment on BMO shares.
Yeah. Okay. Thank you.
Okay. So now at the year end, December 31st. So then this is the issue, right? The measurement. So on December 31st, what's the value of my BMO shares, right? That's the question that you have to answer, right? Because this is your assets, right? On your balance sheet, you have to report a value for this investment. And this is the FV, means fair value, FV. So you're going to report it at fair value, right? Correct? Okay. So what's the fair value of the 100 shares on the year and the date?
Would it be 100,000? Oh, I did 120,000.
Yeah, 1,200, right? Okay. So that's the value you are going to report on your balance sheet, right? So far you recognize the 1,000, right? What's my journal entry at the year end? Can anyone tell me?
So at the end of the year, the excess, the gain you like unrealized gain, so you would debit the fair value through profits and loss investments on BMO shares and credit gains on investments.
For how much?
For the 200.
Okay, very good. Thank you. Okay, so the change is $100, $200, right? Increased from 1,000 to 1,200. So the increase is $200. And because this is the PL, this is recognized through profit or loss, through income, okay? So your year-end entry is you debit your asset for 200 This is the recognition of the increase, right? And then you credit gain on the FVPL investment, 200. And this gain is going to be on your income statement, right? Because this is FVPL, okay? Means the changes in the value will go through income statement. Okay, any questions?
Hey, do you have to specify if it's an unrealized gain, like specify that you haven't sold the investments yet?
Yeah, this is unrealized gain. So the gain will be go through the income statement. So both.
Okay, so you just include it in the notes then that it's unrealized?
I don't know. I don't think so. Because this is FVPL, okay? So it doesn't matter whether it's unrealized or realized. All the gains or losses has to be through the income statement. So okay. What's the point for distinguishing realized and unrealized if all of them go through income statement, right?
Okay, yeah, makes sense.
Does that make sense? Because in this case, if you sell the shares, you have a gain. You still recognize the gain on the income statement, right? So, so basically, this is FVPL, okay? All the gains, losses go through the income statement.
And I would like to add to that too. So as long as you have like a debit balance on your FPVL, it means you have not sold that shares. As soon as you sell it, you would post a credit entry to put it to zero. So as long as you're having a balance, it means it is unrealized.
Yeah, very good. So sometimes depending on the size of the investment, you have to be clear, right? This is FVPL investment on BMO share, right? On different shares, right? You have to be clear. You don't want to aggregate all the, everything into one balance, right? So very good. Good point, Tulu. Thank you. Okay, any other questions?
But the gain is already realized on the P&L, right? So it will already be recognized as income.
Yeah, exactly. It's recognized as income.
Okay.
Because we are using a fair value PL method. Yeah.
Even if you have not, even if it's just a paper gain, you have not really sold the shares yet.
Yeah, you haven't sold it yet. You already recognize the gain. Yeah,
okay.
You already recognize it on the income statement.
Thanks.
Yeah, because we are using a fair value approach, right? Here.
So, sorry, then wouldn't this income statement be very, like, wouldn't it fluctuate a lot? Because, like, if I purchase some stocks that go up and down, like, a lot,
mm-hmm.
then your income statement would be very different, right?
Yeah, so that's why, you have to separately list it, these items, gains, right? Because your regular revenue will be different from the gains, right? So as long as you are not aggregate everything into revenue, right? The users will be able to tell, okay, what's the amount of the gains you generated this year, right? So when they are doing calculations, they're able to take that into consideration, right? Because you presented gains separately from the regular income revenue.
Right.
So the users will be able to take that into the consideration, right? It's not like you aggregate the gains and the revenues together into one number, and then it's kind of confusing, right? Your revenue can fluctuate, can increase, but the user doesn't know, is that due to your good operations, or it's just because you have a bunch of unrealized gains, right? But the fact that, that's why IFRS required these gains has to be separately presented on the income statement.
Okay, yes.
Yeah. Good question. Okay, so I'm going to, just give me 1 second.